Welcome back to the Energy Forum, a podcast from the Center for Energy Studies at Rice University's Baker Institute for Public Policy. I'm Ken Medlock, Senior Director of the Center for Energy Studies. In this episode, we're taking a closer look at the global oil market as we move through the second half of 2025. Prices have remained relatively steady, but there's a lot happening beneath the surface. Demand came in stronger than expected in the first half of 2025. OPEC Plus is phasing out its production cuts, and non-OPEC supply growth is showing signs of slowing. As we look forward, questions are emerging about how price, investment, and supply-demand balance will evolve heading into 2026. Joining us to unpack it all are CES non-resident fellows Abhi Rajendran and Skip York. Abhi, Skip, over to you.
Thanks, Ken. Skip, thanks again for joining the next piece of our conversation focused on oil markets. Over the last several months, there's been a lot going on, and since we put out our last episode of this podcast, certainly a lot has changed. Some things have, kind of been taken out of the focus of the oil markets, and then other things have been added to it. So maybe let's just talk a little bit about, where we are now. Kind of take stock of, looking into the second half of the year. In particular on the demand side, right? Because I think before all the geopolitical tensions rose up, we were focused on the macro, on trade, on tariffs, on Trump, and perhaps the focus is now back on that. So maybe you could just kind of walk us through, where things stand there, where some of the discrepancies lie, and then how you're thinking about the demand and consumption picture.
I think when we came through the first half of the year, now that we've booked the first 6 months of the year, I think we came away with a couple of things. I think we came away with we're a bit surprised. Oil demand in the first half of the year looks like it was a bit stronger than people feared it was going to be. I think it looks like so the high frequency data says demand growth was about 1 million barrels a day versus the first half of a year ago. People were concerned it was going to be more like 700,000 barrels a day. And, there are a couple of reasons for that. One is I think the global economy ended up being a bit stronger than people thought it was going to be. There's probably a couple of that is that the concerns around tariffs probably were the worst case scenario wasn't realized. Oil prices have been a bit softer than people thought they were going to be, and that probably encouraged a bit more demand growth, and that also probably stabilized or put a little bit of a boost to economic activity. You think about the first half of 2024 wasn't in the oil markets wasn't just necessarily a very strong year, so year over year looks a little bit stronger. And we also had a very warm to hot spring and early part of the summer in the Middle East, and that encouraged some seasonal demand that we don't normally see earlier than we normally see in the world. So you roll all that together, and the market looks like it's a bit stronger than people anticipated. And you also sort of see it in the inventories. If you look on a days covered basis, we see that distillate and gasoline inventories in terms of days of supply covered has been declining for about the last 3 or 4 months. We do see stocks of crude building on both a barrel basis and on a days of supply basis, days of cover basis. But we do see the product markets tightening a bit, and that's being reflected in refining margins, which have been strengthening in the second quarter of this year and certainly stronger than they were this time a year ago. So I think we take stock. We ended up with a stronger first half of the year than people anticipated. Now the question is, we can move to the second half of the year, and what do we sort of anticipate? We don't really see. I think people are marking down, specifically in the U.S. The probability of a recession in the U.S. is being downgraded. So I think. No, I don't think we see gangbuster growth, but I don't see anybody sees economic weakness on the horizon for the balance of 25 and moving into 26. The question is, what happens to that seasonal demand in the Middle East? At some point, summer will end, and that demand for extra fuel oil and crude burning into power generation for cooling, that'll ease off. Do we go back to normal? But it looks like we're going to get back into a bit of a normal period. The real outlier still, though, Abhi, right, is what's the tariff policy going to be? Trump has made some progress. He hasn't made as much progress as he promised he would back in April, but some deals have been made. there are more negotiations underway. So I think maybe that's still, a wild card that we need to keep an eye on in terms of as the tariff negotiation goes, sort of so goes the health of the economy, and then that's going to have an impact on the health of the oil markets.
That's right, Skip. And I think the one other thing I would just briefly add to that is over the last couple of months, we've generally had, benign oil prices for consumers, right? For the demand side. And except for those couple of weeks when we had the spikes on concerns around Iran and Israel and the rising tensions there. But now that that's subsided, we're kind of back to the 60s and back to a fairly easy environment for purchasers. And I think that's another key part of it to watch. And I think even through the geopolitical tensions and concerns, there was never a supply disruption, and the supply has been steady. And of course, from OPEC Plus and its tapering plan has been rising steadily over the last couple of months, and will continue to do so, into the latter part of the summer. So maybe we can talk about the supply side too, and specifically OPEC Plus. How are you thinking about the strategy, now with a couple of months of accelerated monthly supply increases, any signs of strain within the coalition? What does the picture look like going to the second half of the year and potentially beyond too?
OPEC had received a lot of criticism for their, sort of maybe their use a favorite, the favorite phrase of Alan Greenspan in the 1980s, the irrational exuberance of their bullishness on the oil demand. And it looks like the first half of the year, maybe that was borne out. You think about they increased, if you think about May and June and July, right? They increased capacity to the market 400,000 barrels a day each month. But if you look at the actual supply, it looks like the number of the barrels that actually came to the market was actually faster than the capacity increases are going to be. And to your point, oil prices have been relatively stable. We did have a little bit of a run up and then a run down around the Iran-Israeli conflict in June. But you put that aside, oil prices have been absorbed those announcements and that volume fairly readily. So I think there's a couple of things that are happening there. One is, as we talked about, demand's been a bit stronger than people anticipated, but also, we're in a price environment where non-OPEC wellhead economics really aren't very strong. And so OPEC plus barrels potentially are finding a home because there's not a lot of economic incentive for non-OPEC plus supply to be growing as much as maybe we thought it was going to be growing, say, 6 to 8 months ago. You look at the U.S. production, and we talked about this in the last podcast, right? U.S. production is fairly flat. There are people saying that we're actually going to see a bit of a dip when we get into the third quarter, maybe into the fourth quarter this year. U.S. production may actually be a bit to the downside. And outside of the U.S., rest of non-OPEC, Brazil showing a little bit of growth. Mexico continues to decline. It looks like Canada, we're going to see a little bit of growth, but we don't see big non-OPEC volumes anywhere like we'd seen in previous years. Somebody normally had the big step out. Even Guyana this year is going to be fairly moderate because although they are bringing more FPSO facilities online, this is actually 2025 is a big maintenance season for the existing facilities. And so even though new facilities are coming online, that new supply is basically filling in for paused production for the maintenance facilities. So even in places like Guyana, we're not going to see big, huge numbers. Now, that maintenance eventually gets completed and that volume does continue to grow. It's not that the Guyana story isn't over yet. It's just that, 2025 is going to be a bit of a pause, even in a place like Guyana. So, you know, just like on the demand side has been a bit stronger than we anticipated, it looks like on the supply side, non-OPEC hasn't been quite as bullish on the volume side as people anticipated. And when you put those two together, that has opened up a window for OPEC Plus to unwind capacity and bring more barrels back to the market. And if you look at their announcements, it looks like most of that 2.2 million barrels a day of voluntary constraint is unwound by the third quarter of this year. The question then is, what do they do with the remaining, what is it notionally, Abhi, what about 3 million barrels a day, 3 to 3.5 million barrels a day that's still sitting off the market? Some of that they're going to want to hold for strategic reasons, and then they're going to unwind some of it. How are they thinking about that next tranche of excess capacity policy? And that's the issue for me. That's the issue second half of 25 and into 26. How do they think about that next tranche of excess capacity policy?
Yep, and the additional cuts on top of the current trench that's almost done unwinding is was almost close to 4 million barrels a day. Yeah, which, like, again, as you noted, not all of it will come back, but there is another slug still to be brought back, right? That's something that the market is kind of thinking about, maybe not this year, but looking to next year for sure. So maybe you want to just talk a little bit about prices, Skip, over the near term. We've got demand that's holding up okay, not gangbusters, but certainly not some of the more dire scenarios that were painted closer to Liberation Day. And then but you've got OPEC plus supply that's kind of pretty much got it covered, right? Whatever the demand growth is, and then you have a seasonal bump for now. But how you're thinking about prices, through the second half of the year, into 2026?
Yeah, so I think this is getting into the part of the year where it's always tough to think about prices because seasonally demand is about to peak. And then we're going to start getting into that easing part for the northern hemisphere. Demand peaks in August, and then it starts to ease off because we get past the northern hemisphere driving season. So if I try to strip that out, if I try to strip that seasonality out, I think we're still sort of in the balance of the year where we're still sort of like, as we're talking today, crude's trading around $68 a barrel. I think we're still in the upper 60s, low 70s through the balance of the year. The market seems to not be afraid of these OPEC plus capacity increases because it really hasn't reacted to the last two announcements, especially that last announcement of 547,000 barrels a day capacity increase. That caught the market. Nobody was expecting that number to come out. But when that number did come out, the market didn't respond. So I think the market is in an accommodation mode for OPEC plus. So I'm thinking balance of this year, I think we're looking at upper 60s, low 70s. We unwind those OPEC plus barrels, and we're in this price, we stay in this price environment. We could be in that sort of that Goldilocks price environment where demand prices are low enough to sort of incent demand growth or stabilize or encourage demand growth, but they aren't strong enough to really incent non-OPEC supply growth. That market, we get into 26, starts to tighten up, and I think we could see some upward price pressure at some point in 26. It starts to show up. And now, when does it show up in 26? That's where I'm still trying to, I can be persuaded that it's in the first half of 26. It all depends on, how those numbers work out over the next the second half of 25. I think is going to really set up what prices look like in the first half of 26. But I think we're kind of in a holding pattern for prices the rest of this year. And if we are in a holding pattern for prices the rest of this year, I think we could see some upward pressure on prices in 26. So I'm kind of curious where your thoughts have been, because you and I have been talking about this on a fairly regular basis, and see if your thoughts have changed much over the last few weeks.
No, I think by and large, share a similar picture and outlook as you. More 60s this year. Kind of the oil market digesting the excess supply, and again, as you noted before, once we kind of get past the summer seasonality and some of the help from the Middle East and driving season and other factors over the next couple of months, that OPEC plus supply is likely to stick. Now, they could also pull back a little bit on exports, right, which have ramped up later in the year. They could pull back, but a lot of that supply is going to stick. So I think even if we are if we kind of keep peaking into the 70s over the short term, we'll probably be more in the 60s, certainly, at the end of the third quarter and for the fourth quarter. I think, you will have a rebalancing that's a little bit faster. So I actually think, more the first half of the year is when you're gonna, kind of stabilize back in the 70s, first half of next year. So maybe that's good segue in thinking about next year and even beyond, looking to 2030 and later, just to shift gears a little bit to, kind of the medium term picture. Let's just say, prices are kind of in the 60s over the short term. And even if they kind of peak into the 70s, right? I think by and large companies have to plan for the 60s. Maybe it's not, 60 per se, but it's hard for them to sort of plan for anything beyond 65. So in that backdrop, you already noted, some of the slowdown on the U.S. supply side, and also a little bit of the slowdown elsewhere. Some of it, kind of because of turnarounds and maintenance and things like that, but also a slowdown in other sources of non-OPEC supply, non-OPEC plus supply. How are you thinking about the CapEx environment, spending, and what companies are doing, in terms of kind of setting up the supply pipeline for let's say the next 3 to 5 years?
Yeah, I think capital discipline is still going to be the coin of the realm. Everybody thought that, when we hit COVID and we saw a lot of capital discipline, especially among the smaller US independents, I think people thought that was going to be short-lived. Get past COVID, prices get back up into the upper 70s or 80s, and then, activity would just accelerate back to where it was sort of in the heydays of, 2011, 2012, and that didn't happen. And I think 5 years on, I think we see that we're in the new phase. Shale is now in the next phase. It's in that mature phase now of where it's about value. It's not about volume. It's about continuing to return capital to shareholders. Maybe not necessarily accelerate returns to shareholders, but continue those returns. And I think that means that capital disciplines is still a key driver in the boardroom decisions as they start, when they start making capital budget decisions for 26 in October, they start thinking about those 26 capital budgets. And if we're right, and if you and I are right, if we're sitting in the 60s when they start thinking about those 26 capital budgets, they're not necessarily going to be cutting capital from their budgets, but they're certainly not going to be adding capital to those budgets. And that kind of goes back to shale is a resource that has to be fed capital in order to stay on the treadmill. The treadmill just gets steeper and steeper because of the decline rates of the wells. So if you're if you're just rolling your capital budget over, that's great. That could be positive for value creation for the shareholders. That's starting to set up a bit of a challenge volumetrically. So you could actually see, a world in which, volume is flat to declining and value is is flat to increasing in terms of returns to shareholders. And I think you're going to see, and that was kind of what we saw going from 24 to 25. I think we'll see a repeat of that. I don't think we're going to see an expansion of capital budgets. I don't think we'll see a big cut, but I don't think we'll see an expansion of capital budgets. I think they're going to pretty much roll over, plus or minus a little bit maybe for inflation. But I think 26 is going to look like 25. And if it does, then that says, the US may not see a production turnaround in 26.
Yeah, I think that's right. I agree with you. I think we're looking at a kind of a flat to slightly down picture for next year. And I think also in the decision making process, regardless of where prices are, I think the lesson of OPEC plus ramping up output for a variety of reasons and having another slog of capacity to bring back online for next year will also kind of weigh on the minds of companies as they budget and think about CapEx for next year, and investors too, right? Who are kind of giving them their feedback and input as well. And so let's just say whether prices are in the 60s or 70s, looking out over the next year or so, I think the last piece of it that maybe we can chat about today is on the demand picture, right? Where I think there continue to be some discrepancies and a divergence of views of what demand will look like for the next 5 years, and then extrapolating that to, to the 2030 to 2040 window, and then, further beyond to 2050. So how are you sort of thinking about, some of those different views? We have, many, kind of looking at a, potential plateau ahead, right, in the 2030 to 2035 window. And then we recently seen OPEC Plus's, latest outlook, which calls for an increase, steady increase through 2050, right? Up to over 120 million barrels a day at that point. And so how are you thinking about some of these different views? What are some of the, signposts that you're looking out for? And in which way do you think things are likely to go?
China is still the country to watch. I think China might be the example. If you want to see how that, not just with oil, but I'll say the broader picture, if you want to see how a country transitions, how the energy transition works on a country basis, China is still the one to watch because there's still a lot of traditional energy, oil, gas, and coal being consumed, but there is still this driven push towards new energy sources, renewables, electric vehicles, LNG, gas-powered vehicles, LNG trucks and whatnot. Some of that's being driven for environmental reasons. Some of it's being driven for the geopolitics of the environments because they want to be seen as a player in the global climate change discussions. And some of it is security of supply. If wind generation and wind and solar power generation doesn't rely on a foreign source of feedstock for power generation. And so China's a great place where all of those are positive forces for energy transition, and they all come together in China. So China is sort of like, in some case, it's the case study for what energy transition can look like when all of the forces for transition come together and push in the same direction. I'd be careful to say that China, therefore, you take China and you extrapolate it out to to all the other emerging countries, because every country has its own pathway, every country has its own resource endowment, every country has its own concerns, its energy concerns or its national security concerns, and so each country will find its own way. I think it is interesting. I was looking at the Energy Institute's statistical abstract that they released last month and doing a little bit of a deeper dive through some of the numbers, and you start to see, we keep saying, well, when is Africa and India going to emerge? Because China's been the driver of energy demand growth in general and oil demand growth in particular. And you can actually see in the data that China's plateauing. It's not going down, but it is plateauing. What you can see in the recent history is you are starting to see a bit of a separation between India and Africa. India, it's not nearly as dramatic as China back in the 1980s and early 1990s, but India is starting to separate from Africa, and it looks like India is starting to emerge. Now, what's that pathway going to look like? Because India is China 30 years removed. So India is going to play with a technology set that is 30 years better than the technology set that China started with. So that's how I'm trying to think about it. Is I think it's going to be dangerous to say that as goes China, so goes the rest of the emerging world. At the same time, I think it would be a mistake to say that nobody's going to look like, nobody's going to follow in China's footsteps. So what I will point out is that if you look at, and OPEC takes a lot of criticism for their oil demand outlook as being overly bullish. But if you look at their outlook out to 2050, and they get up to that oil demand of 120, 125 million barrels per day, 25 years out into the future, only a third of it is transportation fuels, which has sort of been the backbone of oil demand growth for the previous 25, post World War II to today. What really has driven oil demand growth is transportation fuels. From this point forward, in the OPEC view, it's about a third of oil demand growth. The other two-thirds are feedstocks into things like petrochemical and industrial applications. So, and it's not a no EV world. So they've got the EV fleet going from 3% of the fleet today to 20% of the fleet by 2050. Even if they double that, so even if the EV fleet doubles to 40%, which would be a pretty dramatic change over the next 25 years, there is still going to be oil demand growth in that feedstock sector, and that's where the bulk of the growth is in OPEC's outlook over the next 25 years. So my takeaway from reading OPEC's outlook, and as I think about the next 3 years, the next 5 years, the next 10 to 20 years, is the emerging world still wants to emerge. The global South still aspires to have the standard of living that the global North has. It may look different, but they haven't given up on the aspiration. And as long as they haven't given up on that aspiration, it goes back to the old proverbial, it's an all of the above solution when it comes to the energy space.
Yeah, I think it's going to be it's going to be pretty fascinating to watch, because I think to a couple of the points that you mentioned, I think there's going to be a few declining regions, declining segments, and there's going to be offsets, and so it's just all going to be a question about how those all stack up and what that means overall, and then there's going to be growing segments, in particular on the feedstock side as well. So and as you noted, there is still a large gap from a per capita standpoint of what consumption looks like in the developed world versus the emerging world, and so how much of that gap is bridged will be a key piece of it for sure. I think that's about all the time we have. Certainly we've got a lot on our plate and a lot that we will be watching short term, and then certainly transitioning to medium to long term as well. But Skip, thanks a ton for joining this episode of the podcast, and we look forward to the next version.
Yeah, great for having us. I think that, more discussions. The only thing we know about the future is that we don't know what it is.
That's right. Thanks, Skip.
Thank you for tuning in to the Energy Forum. Subscribe and follow our podcast and the Center for Energy Studies for more expert insights on global energy trends. This episode was produced by Maram Hajazi. Until next time, I'm Ken Medlock.